this will go on longer than perhaps the market had timed in. Going directly into the meeting, Fed funds futures had priced in 25 basis points, not 50, which seems like it was very clear it was going to be a 50 basis point hike. That was the case weeks going into this. But minutes before, all of a sudden, folks thought perhaps we'll see a much more dovish pivot and a dovish policy on the horizon. And that's just not going to happen. And I do think it's important that the market ingest that. That said, the reversal wasn't as strong as we saw, say, in September, where when given the opportunity to talk down the stock market, Chair Powell did so in a very violent fashion, and the market dropped, hundreds of basis points, not 85, throughout the course of the meeting. And when under question, the first question actually gave Chair Powell the opportunity to talk the stock market down a great deal. And instead, there was a slight moment of hesitation or pause, and then a relatively dovish response to it. And I think we're now seeing the Fed turn into or change direction slightly. It knows accommodative policy will be necessary at some point. It does look at the inversion of the 90-day Treasury versus the 10-year being a harbinger of recession. And its goal is ultimately to avoid a recession. And that soft landing is possible. Chair Powell made that very clear. It's just not knowable when we can make that determination.
Alex, we're showing a picture of the dollar index on the screen at the moment, and actually what it says to me is that we're trading at our lows of the last 6 months. So how is it the grown-ups in the Forex market can see what's happening and think, yeah, it's more dovish than we have been, and we can see a path to, what can I say, not so much a pivot, but we can see a path to a less hawkish stance, whereas the equity market is still worried about it. Is there a divergence between what the Forex market, possibly also the bond market is saying, and what the equity market thinks?
I think there is a divergence there, and it's self-serving. To some large extent, the bond market is prepared for rates to be high and resetting corporate bond rates across the spectrum. But the equity market is very much set up for a constant 45-degree angle and is looking for any opportunity to grasp onto that and to continue what had been a relatively shocking and persistent bull market. And that said, there's still a lot of green shoots in the equity market. There's still deep innovation in technology companies, even if some of their valuations have been shattered in recent months. But the equity market, I think, in equity market participants are looking for a reason for the market to go up.
Alex, you've caught me on a hook. I was going to say goodbye to you, but some of those growth stocks, the tech stocks, their valuations have been shattered. Yeah, they've been shattered from ludicrous down to mildly ludicrous, though they've got a way to go, haven't they?
They do. I do think they have some downside risk to them left, but at core, some of the companies that were trading at crazy values needed to come back to earth, and they did. But they're not going to just go back to levels that don't make any sense either. I mean, long term, we're not giving up EVs to go back to ride horses or anything of that nature. I do think also many of those growth and tech stocks do have a lot of opportunity in them. It's not going to be as broad as had happened post March 2020, but I do think we're going to find some real winners there. And there's still a lot of capital that wants to find those. And we're seeing that in bouts make its way back into the equity market. And it probably will continue. I mean, many banks after this were still calling for the S&P to end the year at 4,000 or 4,100. That's a 10% rise. And even if we forecast that out on a 90-day or 180-day basis, that's still a surprisingly strong and resilient equity market when fighting a Fed that is very clearly trying to send the message, read our lips, we're going to be at 5%, and we're looking to destroy much of this demand.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.